Hi there! With September behind us, I bought a new stock to add to my dollars dividend portfolio. Watch the whole video to find out which stock I bought and why. Welcome to my channel, where you can follow my journey to set up and maintain a dividend portfolio for my 4-year-old daughter. It's October 2020. I bought the 10th dividend paying stock and will give an overview of the portfolio and the market in September. I'll take some time to analyze a couple of stocks, but since I got diversified along each sector, I had to look at the portfolio in another way to optimize it. If you are new and like to follow my journey and see the dividend portfolio of my daughter grow, then please consider subscribing. I upload a new video each month at least. Let's do a small recap from my previous videos and discuss the market and portfolio in September briefly. I have bought 9 dividend paying stocks, 1 in each sector as defined by Etoro, the broker where I hold my dollars dividend portfolio. I have AbbVie, Disney, 3M, Waste Management, AT&T, Pepsi, Atmos Energy, PPG and T. Rowe Price, and bought them because they are all in a different sector and compared them to 1 or 2 other stocks in the same sector. Well, what happened in the market in September? After an amazing green month, August, the S&P 500 went down from 3,500 to close to 3,400. The month was quite volatile, with ups to near 3,600 and down close to 3,200. The portfolio, which was up 7.1% on the 1st of September, went down as well to 2.9%. Looking at the portfolio, we see that compared to last month, all stocks except PPG went down in September. AbbVie and T. Rowe were hit the hardest and the percentages dropped with approximately 8%. Waste Management, still overall with 28% in the green, did not move that much, and Pepsi just with 1% in the red. PPG, as mentioned before, the only stock in the green and went up 2%. End of August and even at the beginning of September, almost every stock was green overall. Even Disney was close. Now 5 stocks are red overall, but with Waste Management and PPG with 28 and 30% in the green, overall the portfolio is still green. Next to that, I received 6 dividends, 20 cents from Atmos Energy, 70 cents from PPG, 34 cents from 3M, 22 cents from Waste Management, 23 cents from T. Rowe Price, and 27 cents from Pepsi. In total, $1.43, a new record. It may not be that much, but this will be used to buy this month's new dividend-paying stock, to keep the compounding going. As mentioned before in previous videos, the idea behind the diversification over the sectors is to reduce the risk of the entire portfolio, even in a situation or crisis where we are in now. With diversification, it is more likely to have a solid portfolio that can withstand most ordeals and can keep on paying in the future. Reducing risk is an important concept in building a dividend portfolio next to a steady growth. And with a steady growth, I think that receiving some dividends each month, similar to investing each month, is a good idea and worth chasing. This to keep the snowball rolling as efficient as possible. While getting some dividends this month, I thought it was smart to see when the companies I have stocks in do their dividend payouts. So here's the list. In February, May, August and November, AbbVie and AT&T do their dividend payouts. In March, June, September and December, 3M, Waste Management, Atmos Energy, PPG Industries and T. Rowe Price Group do their dividend payouts. Pepsi does their dividend payout in January, March, June and September. And of course, Disney cut their dividend, so no payout from Disney. So I happened to pick stocks that mostly pay out in June, September and December. 6 out of 8 dividend paying stocks. So now I do not have a payout in October, in April and in July, and only 1 in January. Well, I have to do something about that. Most companies pay out their dividends each quarter, so I search for companies that do their dividend payout in January, April, July and in October, to have a more balanced payout throughout the year. I found that the odds of not having a stock that does their payouts in these months is quite low. Since looking at the Dividend Aristocrats, about a third of them does their payout in these months. To search for a stock to buy, they must meet the following criteria. They have to pay their dividends in January, April, July and in October and be a Dividend Aristocrat. Companies that are part of the S&P 500 index that have increased their dividend payouts for 25 consecutive years or more. This left me with 17 options. To make a sort of good comparison between the stocks to buy, I looked if there were stocks in a similar sector and found in the sector consumer goods, as described by Etoro, Kimberly-Clark, Leggett Platt, and McCormick Company. I will analyze and discuss these 3 stocks using 7 steps and buy the best option, in my opinion, at the moment. Do you like how I work and want to buy the same stocks now and in the future as part of your portfolio with no effort? You can make an account by Etoro and copy my trades automatically by using the copy trader feature. Of course, at your own risk. I am not a financial advisor. So let's start with analyzing these companies. First, you take a look at what these companies do in short. Kimberly-Clark manufactures sanitary paper products like baby wipes, diapers and toilet paper. Furthermore, it manufactures surgical and medical instruments. Brand names include Kleenex, facial tissue, and Huggies diapers and baby wipes. Leggett Platt is a diversified manufacturer that designs and produces various engineered components and products that can be found in most homes and automobiles. For example, bedding and furniture products. McCormick Company is an American food company that manufactures, markets, and distributes spices, seasoning mixes, and so on for restaurants and home markets, for example. Now we know a bit what these companies do. Now let's look closer to these 3 dividend stocks. The first step is to look at the dividend yield. The annual dividend paid divided by the stock price and this multiplied by 100 to get the percentage. A dividend yield between 3 and 7% is considered to be a good catch. The dividend yield of Kimberly-Clark is 2.9%, Leggett Platt have 3.9%, and McCormick Company have 1.2%. The dividend yield of Leggett Platt is good, and for Kimberly-Clark with close to 3, it's not good but not bad either. The second step is to check the dividend growth of over 10 years or more, a sign of a solid dividend and a feature that is attractive for dividend investors. Of course, I already went for Dividend Aristocrats, so all apply. Kimberly-Clark has 48 years of consecutive dividend growth, Leggett Platt 27 years, and McCormick Company has 34 years of consecutive dividend growth. All have a great track record and are well above the 10 years criteria. The third step is to look if the payout ratio is under 70%. The payout ratio is the amount of earnings paid out in dividends. The dividend payout ratio is ideally under 70%. You do not want a company that pays out almost every cent they earn to dividends only. That is too risky. You can find it on several sites, but I calculated it myself by dividing the dividends per share, DPS, with the earnings per share, EPS. Numbers that are easily to find, for instance on the statistics page at Etoro. Kimberly-Clark pays out 57%, Leggett Platt pays out 96% of its earnings out as dividend. And for McCormick Company, this is 42%. Remarkable is the Leggett Platt with 96%. That is way too high. The other 2 are fine. The dividend CAGR, or compound annual growth rate, is a fast way to measure the dividend growth. Numbers you would like to see is 7% or more. And if that is not met, then add the previous mentioned dividend yield. If they add up to 9% or more, then it's still okay. Kimberly-Clark has a growth rate of 4.3%, Leggett Platt has a growth rate of 5.5%, and McCormick Company 9.1%. McCormick Company meets this criteria, Leggett Platt meets the criteria when we add a dividend yield. The fifth step is to check the trend of the dividend yield, a way to check the ratio of the stock price and the dividend payout over the years. You would like to see an uptrend where the dividend payout rises more than the stock price. I'll just check out the last 5 years. Kimberly-Clark shows a slight uptrend at first, followed by a slight downtrend because of the strong rise of the stock price. So not good, but not bad either. Leggett Platt shows a nice uptrend with quite a stable stock price. McCormick Company shows a slow downtrend because of the strong rise in the price of the stock, but it's not really good. The sixth step is to look for the year-over-year trends of the revenue of a company. Kimberly-Clark sees a small decline in 2019, but not that bad. Leggett Platt was doing well, but had a 30% revenue decline year-over-year for the quarter ending June 30th in 2020. And McCormick Company has an increase all the way. Very good. The last step, number 7, is looking for increasing year-over-year cash flows. Kimberly-Clark shows a decline over the years. The other two an increase, which is what you would like to see. Now we have walked through all these 7 steps. Let's take an overview of these steps and look at the results. Leggett Platt only meets the criteria for dividend yield, step 1. Kimberly-Clark is close, not good, but not bad either. And McCormick Company does not meet the first criteria. All 3 stocks meet the dividend growth of more than 10 years, step 2, and are even dividend aristocrats. Leggett Platt is the only stock that does not meet the criteria for the dividend payout ratio in step number 3. McCormick Company meet the criteria of step number 4 of the 5-year dividend CAGR easily. Leggett Platt only with the dividend yield added, and Kimberly-Clark does not. Step number 5, the trend of the dividend yield. Leggett Platt meet this criteria. McCormick Company does not, and Kimberly-Clark is not good, but not bad either. For step number 6, the year-over-year trend of the revenue, McCormick Company has an increase through the years. Very good. Kimberly-Clark is not good, but not bad either. However, Leggett Platt does not. For step number 7, looking for increasing year-over-year cash flows, Leggett Platt and McCormick Company look good, but Kimberly-Clark does not meet this criteria. If you rate all these steps with a 1 for good, a half for not so good but not so bad either, and a 0 for bad, Leggett Platt and McCormick Company are close, with a 4.5 and a 5 out of 7 respectively. I actually really was planning to buy Leggett Platt because of the high dividend yield, and other scores are not so bad either. However, the very high payout, the ratio of 96%, is in my personal view at a high risk of a dividend cut at this moment, especially since the situation we are in now is definitely not over yet. McCormick Company has not a very high dividend yield, but has overall more points and seems like a safer choice at this moment. Remember, I am not a financial advisor. This is for entertainment and a bit of educational purposes only. Any investment has risks, so do your own research. So I found my stock to buy, and it pays out dividends in the months where I do not have a payout in yet. And when the market opened on the 1st of October, I bought for 51.43 cents McCormick Company, my 10th stock. If you like this video, please consider liking or sharing this video and subscribe if you haven't already. It helps me to grow this channel. Thanks for watching and see you next video.